some of the work are resolved, so that for those who haven't yet attempted the test and the quiz, that you would be able to get that support that you may need. And then after we do that, after we go over the chapter 14 homework, I will then go back into chapter 15, which was what we were doing on Monday. Just a few things that I want to point out. You likely already know all this, but just as a reminder, we only have about 5 weeks left in the semester after today. Well, after today's meeting, we have about 10 classes, which means about 5 weeks. A reminder to you that, the college's policy, not that I think anybody who's on this call necessarily needs to be worried about this for our class. I mean, we'll see how things go, but just a reminder that the withdrawal date for any class has been extended all the way to the last day of classes, which is June the 4th. So you can still, carry on and see how you're doing right up to the end, and maybe then make the call as to whether you need to be withdrawing from anything. The other thing that I'll remind you about our class is that because the final exam includes topics, that are selected from chapters 13, 14, 15, 17, and 18, if you do better on the final exam than your lowest test score, I will drop the lowest test score. I can't drop the final, so I don't want you guys to plan on that happening. But certainly, if something does come up and and your test isn't maybe it doesn't go how you would like it to, at least there's still hope. I think that you just want to remember there's hope at the end, that if you can beat that test score on the final, then I'll throw the test out. And also similarly for the quiz, I keep the quiz grade if the quiz grade is higher or the same as your test. If the quiz is lower than your test, then I'll throw the quiz out, because the quiz is covering the same material as the test. So, if let's say you get an 80 on the quiz, but you get a 90 on the test, then the quiz won't count, all right? But if you get a 90 on the quiz and an 80 on the test, then the quiz will count. Just whatever is going to get you the best possible grade. And my practice has normally been that, closer to the end of the semester, I normally try to give a little bit of extra credit for those who feel like they may need it, or it's optional, you don't have to do it. And that's normally in the arena of about 10 points that would get added to wherever it helps you the most. It normally helps people the most for it to be added onto the final exam grade. So what that means, if your final exam grade is 70, but you did the extra credit and you got 10 out of 10, then your final exam grade becomes 80. Okay, so I'm saying all these things because I know we're kind of at a critical, we've been at a critical point of the semester because things have just been so difficult and so strange. I know someone's asking me a question. I'll answer you in a second here. I'm saying these things because I just want to try and provide some type of information that might be helpful in your decision making as as we all battle through. I know it's midterm times in some of your other classes where we have a test coming up. You might be feeling overwhelmed. I think many of us are, me included, not so much maybe for me with work stuff, because teaching my classes actually helps me to feel better, but just overwhelmed in general because of the state of the world and the amount of things that are happening around me and in my personal circles. So I guess I'm just trying to encourage you, to ask you to please hang in there with me, lean on me for support if you really can't cope, or if you really need extensions on deadlines and stuff. Please talk to me before just disappearing from the class, because I feel deeply that it's still possible for people to be very successful in this course regardless of the mode that we are in. So here goes the question. If the quiz is higher than the test, I will not drop the test score. No. Let me say it again. if your final exam is higher than your lowest test score, then I will drop the lowest test score. So let's say, for whatever reason, you don't do that great on this test that's coming up now. Let's say you get a 75 on this test and you're not that happy about it. What I'm trying to say is if you can beat that 75 in the final, then I'll throw this test score out and I'll just keep the final will then count more. When it comes to the quiz, right, the quiz that's related to the chapter, if your quiz grade is lower than your test score for these two chapters, I will let the quiz go. So for chapter 13, 14, it's a 10 question quiz. Let's say you bomb out and you get, 70% or 60% on the quiz, but your final is way better, like you get 80, 90 or 100. I won't let the quiz count to drag your grade down. All right. And the decision about which test to throw out, if a test needs to be thrown out, will happen at the end, because I have to see how your final exam grade looks. Look, if your final exam grade is lower than your test scores, then obviously I'll keep your test scores. Basically, the way you should think about it is I'm trying to keep the highest grade that you're getting, on the body of knowledge. It's just that I'm not going to drop any tests until I see whether I can replace them with your final exam score. Quizzes I can drop because I can replace them with a test score. Is that clear? I hope I didn't give more confusion. All right, so again, I'm saying these things, again, the extra credit will come. I'm saying these things kind of to line up what is happening, just so that, again, if you're starting to feel a little bit overwhelmed, vexed, like maybe it's too much work or you're not sure what kind of grade you're going to end up with and so on, I'm trying to work with you guys. And then I guess the bottom line is also, if worse comes to worse for any of your classes, not just for this class, you can also late withdraw by June the 4th and just get a W grade. The other thing that you can also do is opt for the credit or no credit option at the end that you have to apply for if you want to change it. I've mentioned this to you before. I'll just keep mentioning things as we go along. So, closer to the end of the semester, people will be making decisions. But basically what CUNY is allowing is if you get a letter grade A through D, any of those letter grades, if you're not comfortable with the letter grade that you got, then you can just choose to convert that grade to CR, which means you get credit for the course, but there's not a letter grade that's going to affect your GPA. And if you fail, instead of having the F impacting your GPA, you will just convert the F to NC, which is no credit. So that F doesn't drag down your GPA. So that's where we are. Does anybody have any quick clarification questions on anything I just said? Okay. Wait, what did I just do? Okay, I see what I did. All right, so let me then share my screen and we can go into the chapter 14 homework discussion and come back then to chapter 15. All right. So chapter 14's homework, I'm just going to go item by item, exercise by exercise. Stop me if you have questions. Sometimes I can't always see, I don't know, sometimes the chat shows up, like when I have this view, sometimes the chat flashes and sometimes it doesn't. So if you're asking me something in chat and you are able to also speak, just let me know that there's a question in the chat window. All right, so excuse me. Exercise 1401. This is the exercise that is kind of a combination of 13 and 14. We had a similar exercise in our class examples where the company starts with a certain number of shares, they issue additional shares, then they declare a dividend, then they pay the dividend, they issue more shares, and then they declare another dividend. So on January the 1st, Faro Corporation had 91,500 shares of no par common stock issued and outstanding. So that's what they started with. And so it's a no par, but it has a stated value of $4. So you know that you can use that stated value in the calculation of what has to go as a credit to common stock. During the year the following occurred, on April the 1st, they issued 23,000 additional shares of common stock. And if these numbers are not your exact numbers, pardon me, that's okay. Just try to follow along in terms of the mechanics, right, of the question, because I think all of you have the same numbers, and for some reason I think I have different numbers. Anyway, additional shares of common stock for $19 per share. So this is the issue price, right? $19. The formula tells us that for cash, we're going to take the number of shares that were issued times the issue price, which is what gets us to the $437,000. Okay. And then for the credit to common stock, you have to take the 23,000 shares and multiply them by $4, which gives you 92,000. And then paid in capital in excess of stated value is going to be the difference, right? 345,000. You can also calculate that by saying 19 minus 4. So $15 is the excess multiplied by 23,000. That's a little bit of a long-winded way to do it. So the best is to just say 437 on the debit, 92 on the credit. So I still need 345,000 on the credit. Questions there? All right. So then on June the 15th, they declared a cash dividend of $2 per share to the stockholders. So the issue then becomes that you have to make sure that you have the correct number of shares, right? So you have to add the 91,500 to the 23,000, and that's your new number of shares, and multiply that by 2, right? So it's like what, 114,500 shares multiplied by 2. So it's a cash dividend. So it's debit cash dividends 229,000 and credit dividends payable 229,000 as well. And then so that's the declaration date, journal entry, June the 15th. Then on July the 10th, they pay the dividend. So you're going to get rid of the liability. Your debit dividends payable, 229,000, and you're going to credit cash with 229,000. Any questions on the cash dividend journal entry? All right. December the 1st, issued 2,000 additional shares. So 2,000 additional shares, they're just saying in addition to what was already there. So 2,000 times the issue price of 18, that's what goes to cash, right? 36,000, that's the formula for cash, right? The number of shares times the issue price. And then common stock is going to be the 2,000 times the $4 stated value, which is 8,000, and paid in capital in excess of stated value, right? Remember I said be careful with these types of, not minor, but I mean like little things that can go wrong, especially on a test when you have to pay attention. Is it par value? Is it stated value? Otherwise the system is going to mark your answer wrong and the numbers might be correct and you don't understand why the account name is wrong. So 28,000 is the excess over there because 36 minus 8 is the 28. And then on the last day, they declare the dividend of $3. So you add up all the shares, it's 91,500 plus 23,000 plus another 2,000. I believe that's 116,500 times $3 per share. Cash dividends debit 349,500. Credit dividends payable 349,500 as well. Any comments or questions on the journal entries?
Nope, just got to read it carefully.
Yeah, man. It's definitely a matter of making sure that you pay attention to detail, right? It's close reading. Accounting, unfortunately, is not gonna skimming stuff is not gonna help you to get to the right answer. And it's especially difficult sometimes to read closely when you're reading on a screen. I do, well, maybe I'm old fashioned, like I prefer to read on a piece of paper and mark up the question. But I think if you keep a piece of paper next to you and just make notes or something of important stuff, that can also be helpful. So the second part is the one where, a few people contacted me and said, like, what do we write here? What's going on here? What they're trying to just ask you here is, how does all of this that you just did now, how does it translate into the financial statements? You can see the numbers changed here for whatever reason. I think these are the numbers that you guys had. Um, so, or many of you had, because when I was grading your work yesterday or last night, I saw the question that some people had. I don't know, the system is, in my opinion, a little bit flawed on this question. So the point maybe is not so much about what's the dollar amount of dividends and dividends payable, because it might be varied for some of us. But the point here is, how do we show these amounts, right, in the financial statements? So the easier one to think about is dividends payable. It's in the name, it's a payable, so it's a liability, and specifically a current liability. That's what I needed to see in your answer. Not just that it's a liability, but that it's a current liability in the balance sheet, because they say reported in the financial statement. So you actually have to also mention that it's in the balance sheet. And then how are dividends reported? So dividends, and many of you wrote this, so good on you. Dividends are a subtraction or a reduction of retained earnings. And sometimes companies will either show retained earnings statement, where they will reconcile retained earnings, like how we did the calculation of how to get to the balance of ending balance of retained earnings, or they will have a stockholders equity statement, of which retained earnings is a component. So if we look at the solution, you can see how the numbers that they have in the answer are different to the numbers I just calculated in 1401A. Again, when I was, trying to, or grading your work, I was just trying to follow whatever you guys had in your questions. But here's the answer, such as it is from the textbook, right? In the retained earnings statement, or even if you just said in retained earnings, I don't necessarily feel like you needed to show that you knew about the statement. Dividends are deducted. That's what I'm looking for. So dividends are deducted from retained earnings. In the balance sheet, dividends payable is a current liability. So that's the crux of what was happening here. Some people got a little bit sidetracked with this and tried to explain every journal entry. I think the key here that you want to focus on is that they're asking you, how is this shown in the financial statements, which tells you that they're not looking for you to explain journal entries. They're looking for you to explain presentation, right, of numbers. So if you look in the balance sheet, where on the balance sheet would these numbers show up, and how are they treated? Questions on that? Okay, apparently, let me see in the chat if anyone's looking for me. Nope. Okay, so you're good. All right, next question. Do it review 1401A. So this question, or these questions, I find with the test, there is a question like this about allocating dividends between common and preferred stockholders, and generally people struggle with this type of question. And I think, I'm not taking the test, and obviously I teach the material, so it's maybe a little bit more difficult for me to figure out exactly what the problem is, but I suspect it's got to do with the understanding of cumulative and non-cumulative. It's also got to do with understanding how to calculate the preferred dividend, and then the notion of dividends in arrears, right, when dividends are carried over. So I'm going to go kind of super slow through this. I know some of you already did it and you have the correct answer, and you may not be that phased, but I feel compelled to just make sure that we thoroughly go through specifically this type of question, because people sometimes get overwhelmed in the test with this question. So Bramble Corporation has 3,000 shares of 7%. So the 7% is the dividend percentage on 110 par value. So each share is entitled, when the dividend is declared, right, to 7% of $110. And that then is multiplied by 3,000 shares to tell you in total what the annual preferred stock dividend is. So the preferred stock are outstanding, meaning outside of the company, at December 31, 2020. At December 31, 2020, the company declared $130,000 cash dividend. Now, what you should obviously know by now, and I mean, this is fairly obvious, but I'll say it, is that the $130,000 cash dividend declared as a kind of a overall total is going to be split, right, between preferred and common stockholders. But since preferred stockholders have preferential treatment, they stand first in line and they have to get their dividend first, and anything that remains goes to common stockholders. So determine the dividend paid to preferred stockholders and common stockholders under each of the following scenarios. The preferred stock is non-cumulative. So non-cumulative means that if we don't get a dividend in 2020, then we lose it, right? Once we get to 2021, we can't look back and say, hey, you didn't pay me last year, because the dividend does not accumulate. So if the company, it says the company has not missed any dividends in the previous years, but it kind of in a way doesn't matter, because as soon as it's non-cumulative, it means that the previous years are irrelevant, right? You're only dealing with the current year, because anything that happened in 2019, 2018, 2017, and so on is not going to impact 2020 because of the fact that it is non-cumulative. So when you want to start out this question, you say, how much money do I have to allocate? I have 130,000. How much of that absolutely has to go to preferred stockholders? Well, it's 3,000 shares times 7% times 110. So the answer is over here for us, right? 23,100. And so out of the 130,000 dividend, 23,100 goes to preferred stock. And as you know, common stock gets the residual. So that's 106,900, because together this has to add back up to 130,000. Questions there? All right. Number two, the preferred stock is non-cumulative, and the company did not pay a dividend in each of the 2 previous years. So we're back to this non-cumulative. And like I said, if the preferred stock is non-cumulative, whatever happened in prior years is irrelevant. It just doesn't matter. So whether they paid the previous years or they didn't pay the previous years, we don't care because of this word, okay? Because there's no look back to previous years because of non-cumulative. So this answer is going to be exactly the same. See how the previous years don't matter? In this thing, it says that the previous years, they paid everything. Here it says they didn't pay anything, yet the answer is still exactly the same. So this is the type of thing that might throw people off in a test, because they might be thinking, wait, but here they said they paid something, here they didn't pay something. How come the answer is exactly the same? You have to be aware of non-cumulative is what's driving that answer. And then in the last one, the preferred stock, so there's the change, right? The preferred stock is cumulative. That means, again, that if we didn't get paid in previous years, in the current year, we have to get paid for all the prior years and then also the current year. And you always settle the previous years first, right? It's just like if you had a bill with like Con Edison or something and your bills were overdue. When they receive money from you, they apply that money to the oldest balance first. So it's the same with these dividends. They're going to pay the previous years and then they'll pay the current year if there's enough money. And then anything that's left over will go to common stockholders. So here you have to be careful, right? Because it says the company did not pay a dividend for each of the 2 previous years. So it's 2 previous years plus the current year. That's how we get to 69, right? Because 23,100 multiplied by 3 for 2020, for 2019, and 2018, not just multiplied by 2. So that's 69,300. You subtract that from 130,000 to get to a residual or leftover for common stockholders of 60,700. Questions on any part of this solution?
Yes, how you get the 60,700?
60,700. So if you run it on your calculator, right, just take 130,000 total minus what goes to the preferred stockholders, 69,300, and you should come out to 60,700. Yes, no, maybe.
Yep. Perfect.
Yeah,
Thank
so
you
here's the solution. I could have actually, sorry, I should have just done that. So it's that 130 minus the 69,300, and the 69,300 is 3 times the preferred dividend because it's 3 years, 2 years previously and the current year that they have to settle.
Yeah,
Any
that's
other
the one I
questions?
had to read that. I got that wrong the first time. I was like reading. I was like, what's this going on?
Yeah, what were you doing? Just 2 years?
Yeah.
Yeah, and that's why I was saying you want to be very careful because it's talking about the two. This is the key words, right? Previous years. So you almost have to write it out. Like I said, having a piece of paper next to you and write it out. So there's 2 previous years. That's gonna be 46,200 plus the current year's 23,100. That's how we get to 69,300. Other questions? All right. And so, yeah, we come again to this allocation business. And like I said, please be careful with these allocation questions. I normally find that people are okay on this test for the most part. They get stuck on the allocation sometimes, though. So Crane Corporation was organized on January the 1st, 2019. During its first year, the corporation issued 2,050 shares of $50 par value preferred stock and 106,000 shares of $10 par value common stock. All right, so that's what's issued and outstanding. Do we care about how many shares of common stock and the par value and so on? If we're doing a dividend allocation, we don't care because the common stock will just get whatever is left over. You don't need to involve the shares and the par value and so on in that calculation. With the preferred stock, you do care about the number of shares and the par value because that's 2 of the 3 parts that you need for calculating a preferred dividend. The third piece that you need is the percentage. And the reason it's the percentage isn't in this preliminary discussion is that the percentage is changing, right, between the 2 parts of the question. So at December 31, the company declared the following cash dividends. For 2019, they had 5,975, 2020, 14,400, and 2021, 27,500. So if you're attacking this question, your first thing obviously is to read all this stuff at the beginning, which looks sometimes very overwhelming because it's so much information. But the more you read it closely, the easier it's going to become to discern what it is that you need to pull out of the information for yourself to use in the question. Show the allocation of dividends to each class of stock, assuming the preferred stock dividend is 7% and non-cumulative. So there's a 7% that will apply to the $50 par value to get the dividend per share and then multiply it by the number of shares. Non-cumulative, we know, means it doesn't matter what happened in previous years, whether we got paid or we didn't get paid. We just concentrate on the current year. Okay, so you don't have to carry forward dividends in arrears and things of that nature. So your next step, so you read everything, you understand the terms, you pulled out the pieces of information that you need to answer the question. Your next step is to actually calculate right, the preferred dividend per year to see how much money the preferred stockholders are entitled to and compare that to the dividend that was declared. So if you take 2050, right, you multiply it by the $50 par value and you multiply that by 7%, you see that the dividend should be $7,175 per year. But in 2019, we only declared a dividend of $5,975. So now the question is, can we give the preferred stockholders $7,000 if we only declared $5,900? Yes or no?
I'm sorry, I didn't hear your question.
Can we allocate more dividend than what we declared? Can we give them $7,000 if we only declared $5,975? The answer
No.
is no, right? You can only pay what was declared. So since we declared $5,975, even though the dividend is supposed to be $7,175, it doesn't matter. You only give them what you declared. And unfortunately for common stockholders, they are going to get zero, right? They get a big fat zero because there isn't enough money to cover everybody. So in 2019, the preferred stockholders ended up getting less money than what they should have, right? By about $1,200, they're lower than what they should be. But because the preferred stock is non-cumulative, that $1,200 that they didn't receive is irrelevant because next year it doesn't carry over. Okay, so we're basically in a situation where they just lose that amount of money because the dividend that was declared was less than what they were, than what the preferred stock dividend per year is. Questions? Yeah, on 2019. All right. So in 2020, same story. You multiply 2,050 shares times $50 per share times 7%, and you see that the annual preferred dividend is $7,175 still. But in 2020, we have a bit of a better situation because they declared a total dividend of $14,400, of which $7,175 will go to preferred stockholders, and the other amount, the leftovers, basically $7,225, will end up going to common stockholders. Notice that the deficit from the previous year does not carry into 2020 because of non-cumulative. All right. And the last one is 2021, same preferred stock dividend, 7,175. And because the total dividend that was declared was so much larger, 27,500, common stock benefits by getting 2325. So this is, you know, the thing with common stockholders, that when the going is bad, it's really bad. They basically get nothing. But when the going is good, there's no upper limit to how much money they can get in the dividend. Any questions on part A? Pardon. All right. And then in B, just make sure no one's looking for me. Okay. In B, it's, you know, similar. Obviously, it's the same information from on top, but they changed the dividend percentage to 9%, and now the dividend is cumulative. So cumulative now means that you're going to have to keep track of how much money they did not receive, right, in the previous year, because if there's anything that's still owing, it has to be added on to the current year. So now with the 9%, again, you know, reading, like you were saying, Jimmy, reading the question carefully, because if you don't pay attention, you might just continue with the 7% from before, but the percentage has changed. So with the 9%, you're going to punch into the calculator, right? 2,050 shares multiplied by $50 par value per share, multiplied by 9%. 9%. So it's going to be 9,225 as your preferred stock dividend per year. You're in the same trouble in 2019 as you were before, because they only declare a dividend of 5,975. So that's all the preferred stockholders can get, and common stockholders get nothing. So 5,975 is much less than the dividend that they should have. So there is what we call an arrears, right? The arrears is the difference between what they should have received, which is 9,225, and what they did receive, 5,975. And that amount of the difference is $3,250. So that gets carried over to the 2020 year. And in 2020, they are also still going to be entitled to their dividend for 2020, but we also have to pay them the leftovers from 2019. So this 12,475, and I think it's going to be, let me see if I can see it over here. Yeah, all right. So the 12,475 is going to be the previous year's 3,250 that was not paid, plus the current year 9,225. So that gets you to 12,475 for 2020. And out of 14,400, then the common stockholders only get the remainder of 1,925. Do I need to repeat any part of that? This is where things get dodgy. So does anybody need me to repeat something?
It's just that the common stock is not cumulative.
Yeah, no, common stock will never be cumulative. There's no, you can't calculate anything that's owing to common stock. I mean, it's the nature of the common stock that nothing is really owed to them. They take the residual, or, you know, they take whatever was declared to them specifically. But there's no way, you know, looking at this, the 106,000 shares with the $10 par value, there's no way to say, oh, they were owed something from before. They're not. They're completely non-cumulative, right? What happens in previous years is irrelevant. It's just in this one, the preferred stock is cumulative. So if they don't get paid what they were supposed to get paid in the previous year, the next year they have to be paid whatever is owed from the prior year plus what they need to get for the current year. And then the last one, 2021, the dividend declared is 27,500. The preferred stock, everything that was owed got settled in 2020. So in 2021, all they get is the regular dividend, which is the 2,050 shares times the $50 par value times 9%. That gives you 9,225. Deduct that from the total dividend of 27,500, and common stock gets 18,275. The floor is open for any further questions.
So we never have to worry about the common stock. When they give the numbers of 106,000 shares, we don't have to.
Yeah,
worry.
you don't care about that. And when it comes to what dividend does common stock get, it's basically just you derive the number. It's a calculation because it's the difference between the total dividend and what was paid to preferred stock. You know, you always will have to calculate what goes to preferred stockholders first before you can even calculate what the common stockholders get. What else? Anything else? Questions? Nope. Okay, so watch out for this question or question like this in the test. Make sure that you've got your wits about you with this cumulative and non-cumulative business, and don't sit and take the test with just a calculator next to you and no paper or something, I think it's important to try to work out some of these answers methodically, on a piece of paper, and then you can always just transfer your answer into the system. But sometimes it gets a little bit overwhelming to just type things into a calculator, and whatever the calculator spits out, that's supposed to be your answer, but then you can't go back and see where you might have keyed something incorrectly or made an incorrect assumption. Whereas if you sit with a few blank pieces of paper and you write out for yourself, okay, especially with something like this for 2020, because it's cumulative, you can write there, what's the dividend that's owed from 2019, what's the dividend that's owed in 2020, what's the total of that, subtract that from the total dividend declared, and you can get, what the common stockholders are owed. And hopefully when you, check your work, if there is still an error somewhere, you at least have a record of how you came to your answer, and maybe it might be easier to find mistakes than if you're just typing stuff in cold into a calculator. Then you clear the calculator, and then afterwards you have to redo the whole calculation again. So, strategically, I've had, students who tell me they have had better success with just doing manual calculations first and then putting the answer in afterwards. And please remember to, I've said this before, I know that it's obvious, but please remember to hit submit when you are comfortable to hit submit, because once you hit submit, that's your first attempt at the question. Remember, you have 4 attempts at every question with varying losses of points along the way. The system warns you about how points are lost. I just want to show you also, like when you go into the test initially, it will also show you, right, how the points system works. Over here, you can go crazy up to 5 attempts, but after the 5th attempt, you start losing points if you ask for show solution, right? So some of the stuff you don't have to click on, like if the system says, oh, you have an option to show the solution now, you can refuse that so that you can try to still get 100%. But if you get really stuck and you want to show the solution, then obviously the points are going to be affected. So just to finish this question, every time it's like algorithmic. Every time I click on the question, the numbers change. But for the last part, it was just to journalize the declaration of the cash dividends. You just got to watch the year, okay? Again, so read carefully, December 31, 2021. So whatever the amount of the dividend was, sorry, I forgot that it changes. So now it's suddenly 28,500. But the point is the journal entries debit cash dividends and credit dividends payable, right? That's all you have to do. You don't have to split it between preferred and common stock and all of that stuff. It's really just a plain journal entry for recording cash dividends, right? So now the next question is stock dividends, which sometimes also gives people a little bit of a pain because it's a very systematic, methodical way of calculating this thing. And if you don't study how to do it, you won't be able to just figure it out because there are too many bits of information that can become confusing. So Concord Corporation has 41,500 shares of $12 par value common stock outstanding. So that's right, the common stock, the number of shares, the par value. It declares a 15% stock dividend. So this is kind of similar to what we've had in the past. This is considered a small stock dividend, which means that you value the entire stock dividend at the market price of the shares. And you can see on December 31, when the market price is $18 per share, and then the dividend shares are issued on December the 31st. So what's the approach for stock dividends? Your first question you have to ask is what's the number of shares that are outstanding on the dividend declaration date, right? That's a critical question. And in this case, it's fairly simple. It's 41,500. Nothing else, has been added. So then you ask yourself, how many shares are in the stock dividend, right? That's the next question. So question one is how many shares are outstanding on the date? And then question two is how many shares are in the stock dividend? So if we apply, in this case, again, the numbers are different, but 41,500 times 15%, there should have been 6,225 shares in the stock dividend. That is not a dollar amount, which means that is not an amount that you should be trying to journalize, all right? That's just an amount that you are using to try and apply the market price or the par value, depending on which part of the journal entry you're working on, in order to put a dollar value to the stock dividend. So remember, stock dividend is what the company issues when they don't pay cash. And the reason that we value the stock dividend at the market price of the shares is that an investor who receives those stocks could turn around and just sell the stock at market price, right? So that's basically the fair value of the stock dividend. So we know we have 6,225 shares in the stock dividend. How do we come up with this number? Stock dividends, this is formulaic. It's going to be the number of shares in the stock dividend multiplied by the market price, right? So if you take the 6,225 and you multiply it by 18, you're going to come out to 112,050. That's the debit. That's excuse me, how the debit amount gets calculated. For the credit, it's not common stock. Please be careful here. Remember, we haven't issued the shares yet, so we can't put common stock. We have to put common stock dividends distributable. It's almost like saying dividends payable, but you can't put dividends payable because this is not going to be a cash payment, right? Sorry, my throat is dry. So common stock dividends distributable. What you do there is you take the same number of shares, which is right 41,500 times 15%, so 6,225 shares, and you multiply them by the par value of the common stock, because this number is like a placeholder for the common stock account. So you're going to multiply by 12 and you get to 74,700, and the paid in capital in excess of par is just going to be the difference between these two numbers. Questions there? I'm hoping I'm hoping that this is helpful, right? That I'm not boring people to tears. Maybe you already know everything, but I suspect here and there might be a few useful hints. So if people are okay with this, this is these are the three accounts that are involved in this order in the journal entry to journalize a stock dividend. So you just have to remember again that stock dividends is the number of shares times the market price. Common stock dividend distributable is the number of shares times the par value, all right? And the excess is just the difference between those two numbers. Then when it comes to December the 31st and the shares are actually issued, you get rid of the common stock dividend distributable account because it was a placeholder, right, until we issue the shares. Now that it's done, it's a stockholders equity account, so it went up on the credit side. Now it's going to go down to 0 on the debit side, same amount from before, and then you just credit common stock because now those shares were actually issued.
How do you know it's just for the common?
As opposed to what, it being preferred or something like that?
Yes.
The question will tell you that. And if the question doesn't explicitly state common stock, then you can assume that it's common stock. It's very rare to have a stock dividend on preferred stock because preferred stock dividends are usually contractually stated as a percentage of the par value. Does that make sense?
Yes.
Okay. So, failing any proper information from the question, you are well within your rights to assume common stock. It just wouldn't make sense for preferred stock to have a stock dividend as a dividend if they already have a stock dividend percentage given. Anything else? All right. 1403. more stock dividends. I can go a little bit faster here, hopefully. On January the 1st, Ivanhoe had dollar amount, so you got to be careful here, right? 1,470,000 of common stock outstanding that was issued at par. So pardon me, you don't know what the number of shares is right now, and the reason they're doing this is because they're trying to test you to, if the par value changes, how does the number of shares change, etc. It also adds retained earnings of 741,500, excuse me. Does it matter about this retained earnings? Do you need to journalize it? No, you do not. It's kind of extra information that's given to show that there is hopefully, I guess, enough retained earnings to do a dividend, but it kind of in a way also doesn't matter because the stock dividends, well, actually, let me not say that. It kind of does matter in a way, but maybe the bigger way to think of this is you don't have to do any journalizing of this retained earnings number. The company issued 41,500 shares of common stock at par on July the 1st and earned net income of 400,000 for the year. So, so this then, there's a few moving parts here. I'll take them one at a time. The first question is this 1,470,000, how many shares does that translate to? And once we know that number, we still have to add this extra 41,500 shares to that number as well. All right. And then they've got 741,500 of retained earnings. And to that, they're still adding an extra 400,000. So I guess what they're trying to say is we're going to have enough retained earnings to cover the stock dividends, because remember, stock dividends closes out to retained earnings. Journalize the declaration of a 15% stock dividend on December the 10th for the following independent assumptions. If the par value is $10, then we already know that we can figure out how many shares this translates to. You're taking 1,470,000 and you divide by 10, so you know that's going to be 147,000 shares that this represents, right? 147,000 shares on January the 1st. Now, remember I said the first question with the stock dividend is how many shares are outstanding on the date of the dividend. The dividend is declared on December the 10th, which means that not only should we be looking at the 147,000 shares from January the 1st, we also need to add the 41,500 shares from July the 1st. So you add 41,500 and you come out to a total number of shares for this part A of 188,500. So then the next question is, how many shares are in the stock dividend, right? So you know that you have to apply a 15% stock dividend percentage. So you multiply by 15% and you see that the number of shares in the stock dividend is 28,275. I know I'm throwing around a lot of numbers here and people are like, what? You can stop me, or remember this thing is being recorded. So at any point you can, after I post it, you can go back and do the calculations. It's a little bit awkward because I'm sharing the screen. So I'm not able to to write out the calculation. That's why I normally prefer to use Excel, but I just want to stay in the question because you guys may be following in your own Wiley anyway. So the number of shares in the stock dividend is the 188,500. Total shares multiplied by 15% is 28,275. For stock dividends, how do we calculate that? We have to say the number of shares in the stock dividend multiplied by the market price. So that comes out to 508,950 because it's 28,275 shares multiplied by $18 per share. For common stock dividend distributable, you take the same 28,275 shares, but you multiply it by the par value, which is $10 for this part of the question. That's how we get to 282,750. And the paid in capital in excess of par, as usual, is the difference between these two numbers. You've got 508,950 on the debit side. You subtract this 282,750 on the credit, and then you see that you still need 226,200 on the credit. Questions, please. And I'm just trying to see, yeah, so I keep forgetting that I do actually have a type of solution here, because you can see what I was, and you guys have access to this. I was talking about working out the number of shares, right? And then this is incorrect. There shouldn't be a dollar sign here. I don't know what Wiley is doing, but it's basically 147,000 shares plus 41,500 shares multiplied by 15% doesn't give you $28,000, it gives you 28,275 shares. You multiply those shares by $18 to get to the stock dividend amount, multiplied by $10 to get to the common stock dividend distributable, and then you can just subtract these two numbers to get to the paid in capital, or you can take the excess, which is $8, and multiply it by the number of shares as well. For the second piece, the par value changes to 5, right? So you're starting again with 1,470,000, and you divide that by 5. That tells you that you had 294,000 shares outstanding at January the 1st. To that, you add the 41,500, which gives you 335,500 shares that are outstanding at December the 10th. You multiply that by 15%. And again, you know, like I said, Wiley is wrong here. This shouldn't be a dollar sign. This is the number of shares, 50,325 shares in the stock dividend. And for this question, they say that the market price is $21. So you debit stock dividend with the 50,325 shares multiplied by the $21. And that's how we get to this is not what I want to do. That's how we get to 1,056,825. And then you take the same 50,325 shares, multiply it now by the $5 par value that they've given you in the question over here. And then that gives you 251,625. And like I said, you can just subtract these two numbers from each other to get to the credit for the paid in capital in excess of par. All right, so that is that. Last call on stock dividends. All right. So 1409, you're just calculating retained earnings balance. There is an example or an exercise like this in the test as well. Remember, you want to be sure that you are thinking about what the components of retained earnings are. You have a beginning balance, you add net income or you subtract net loss. Any cash dividend is a subtraction and a stock dividend is a subtraction as well. If there is a prior period adjustment, whether that adjustment is going to result in an addition or subtraction from retained earnings will depend on the nature of the error. And remember, we went through errors where we said that if expenses and net income are going to move in the opposite direction to each other, net income and retained earnings are always moving in the same direction. Revenue moves in the same direction as net income and retained earnings. So what do I mean by that? If an expense is too high, net income will be too low and retained earnings will also be too low. So you have a sheet about this. Let me just go into our Zoom call materials and show you. So I don't want to, belabor the point / beat a dead horse here. So I'm not going to go over everything. But if if you still are trying to solidify your knowledge of errors in retained earnings, this sheet I went through at length in the class before is what I'm talking about, that you'll be able to go through and see the impact of errors on retained earnings. Let me just go back into this. Okay, so we have a retained earnings balance at December 31, 2019 is 319,500. That's the ending balance in 2019, which becomes the beginning balance in 2020. I'll just try and put the solution over here. So you can either do this just in a row with adding and subtracting. They chose to do a T account, which is also fine. So 319,500 is the beginning balance, obviously on the credit side, because the normal balance of a capital account is on the credit side. The plus side, Sandial had 194,500 shares of common stock outstanding at the beginning of 2020. The following transactions occurred during 2020. A cash dividend of 50 cents per share was declared and paid. So you're going to take that 50 cents and multiply it by 194,500 shares, which gives you a cash dividend of 97,250. That's going to be a subtraction from retained earnings. A 10% stock dividend was declared and distributed when the market price per share was $19 per share. So 194,500 shares times the 10% stock dividend gives you 19,450 shares in the stock dividend. You multiply that by the market price per share, because that's what goes to stock dividends, which is what eventually gets subtracted from retained earnings, gives you 369,550. That's also a subtraction from retained earnings. And then net income of 281,000 is an addition. So in the end, your retained earnings balance is 133,700. Questions on this one?
Sorry, I got lost at the ending part.
I lost what on the stock dividend?
When you went to the net earnings to get the retain.
All right. So I mean, the other way to look at it is over here. If you don't look at the T account, excuse me. So again, we start with the beginning balance, a plus of 319,500. There's another plus to that, which is the net income of 281,000. The minuses are going to be the dividends. The cash dividend should be pretty obvious. It's 50 cents on 194,500. So that's 97,250, right? Subtract. And then the stock dividend is basically just based on what we were doing before, right? You take the 10%, oh, sorry, where did my solution go? You take the 10% and you multiply it by the 194,500 shares. And that number is the number of shares in the stock dividend. You multiply by the market price to give you a subtraction, right, of 369,550. So in the end, the balance is 133,700. So you have to just remember that net income gets added, net loss gets subtracted. Dividends will always get subtracted from retained earnings. Are you still lost?
So if they already gave you the net income, so you don't need to do the other calculation, right?
What do you mean other calculation? Are you saying you don't need to do the dividend calculations?
Yeah.
No, you absolutely do have to. Remember, retained earnings is all the net income, but it's the net income that was kept back in the company and wasn't distributed. So since there were distributions for this year, you also have to subtract those distributions from the retained earnings balance. Net income isn't after dividends, because remember, dividends aren't an expense. So the dividends are never subtracted in the income statement from the net income. They have to be subtracted separately from the retained earnings balance.
Got it.
Right? So that, I think that was the missing link. Net income is just revenue minus expenses plus any gains minus any losses. Dividends are distribution of net income, so they have to be subtracted after you already calculated your net income balance. Other questions? Okay, and so you want to just remember, what goes into retained earnings. I don't know if this is going to bring up a good, I'm just taking a chance here. I know that in the book there's a T account also where they show you, yeah. So illustration 14.13 tells you again just all the stuff that I was just talking about, right? Of what gets added and subtracted to retained earnings. You have to remember that so that when you're doing these calculations, you don't get thrown off. 1408 is similar. It's also a calculation of retained earnings, but here we have an error that we have to fix as well. So on January the 1st, 2020, Columbia Corporation had retained earnings of 532,000. That's the beginning balance, right at the beginning of the year. And you need to include that in your calculation, as I said previously. During the year, Columbia had the following selected transactions. They declared cash dividends of 112,000. So this question is different, right? Because they don't ask you to calculate the dividends. They just give you the dollar amount. But, this dividend still has to factor into your calculations. They corrected an overstatement of 2019 net income because of an inventory error of 36,000. Net income was overstated in the previous year, which means that retained earnings was also overstated. So to fix an error where the number was too high, you will have to subtract from the balance. Okay, so again, watch out. It's saying an overstatement of net income, not an overstatement of an expense, right? Earned net income of 341,000 that gets added to retained earnings and then declared a stock dividend of 56,000. So if we look at what they're doing here, again, they're preferring to use the T account, but you can also see at the bottom here, they explain how they do, just the numbers calculation. So the first thing is the beginning balance is, a plus. It's on the credit side, 532,000. You add net income that belongs on the same side as the beginning balance. It's an addition. You subtract the cash dividend because that's a distribution of retained earnings. So that's a minus. That's why it's on the debit side. You also subtract the stock dividend of 56,000. So just like I said before, the dividends are always a subtraction, right? And then, like I said, the overstatement of net income would have resulted in an overstatement of retained earnings in the previous year. So the retained earnings has to go down by the amount of the overstatement. And so your ending balance becomes 669,000. Questions there or something I have to repeat?
No, we're good. Thank you.
Yeah, and guys, for those who are maybe shell-shocked, I'm going through this stuff fairly quickly. I mean, this homework takes time. It takes hours or whatever to finish. I'm basically motoring through the solution in an hour, which, is more than the syllabus even allocates to me to do. I'm trying to just explain some of the, I guess, some of the things that might give you issues on the test. If you're feeling like for some of the stuff you have no idea what I'm talking about or whatever, please, do yourself a favor and go and try and redo these examples a few times. I also, before I finish up here with this income statement, I also just want to, because it's relevant, want to just remind you that as promised, I put the full solution for chapter 14 up yesterday, since, the homework was due the day before. So this then means that you have access to other answers, or all the answers really, for the not just the homework questions, but also for other questions that are, in Wiley. So you can practice by trying to do some questions and then looking at the solution that way. And I'll show you in a second here how you get to the extra questions if you want to practice more questions. So 1412 is just an income statement. pardon me. Remember, I told you for this one, please, however you need to do it, just have a template of an income statement somewhere near you or next to you while you do the test. Because if I had given you an income statement to prepare in class, I would not have expected you to memorize all these different names, because if you were working in a company, they would have a previous year's income statement that you could work off of. So my aim is not for you to have to spend time, and sometimes people miss the boat with this, spending more time memorizing the names and the order of the thing, and then they don't know how to actually calculate some of the stuff. So again, please, just if you need to print something out or take a picture or whatever, just have the template of the income statement available for yourself during the test. So you don't have to worry about that. And the same goes for the balance sheet in Chapter 13. The following information is available for Faro Corporation for the year ended December 31, 2020. We've got sales revenue, other revenues and gains, operating expenses. So you see how these things are just given in a random order. And that's what I mean. When you open this question in the test, it's going to be all blank, and you'll have to know what order the stuff goes in. And, a lot of people get stuck because they don't know the order, and then they can't answer the question. Cost of goods sold, 468, other expenses and losses, 34,500, preferred stock dividend, 43,050. I know I went through this question once before when we were going over income statements in Chapter 14, but I'll remind you again what I said at the time, that a dividend is not an expense, so it has no business being in the income statement. I just also said that for the previous question. So this information is actually being given because you are being asked to calculate earnings per share later on. The company's tax rate was 30%. That is needed because you have to calculate income tax, and it had 54,000 shares outstanding during the year, not needed for the income statement, but certainly needed for earnings per share. So prepare a corporate income statement. They want you to remember here that an income statement is for a period of time. So it's for the year ended December 31, 2020. You start with your sales revenue, you subtract the cost of goods sold. Yeah, they're just trying to say that they would accept a number with no minus sign or with a minus sign. You could go either way because it doesn't tell you to use parentheses or anything. What it does, however, tell you is to list other revenues before other expenses. So you do need to read instructions properly, because otherwise if you put the other expenses before the other revenues, it's going to mark it wrong, okay? And it's because inside of this, of this income statement, they obviously have their computer programming to know what to add and subtract. So these two numbers are deducted. Gross profit loss is 322,000. And this is what I mean when I say I'm not worried about you trying to memorize all these names. I need you to know simple things like, and I know this sounds obvious, but in the heat of the moment, people will do things like adding cost of goods sold to sales revenue instead of subtracting it to get to gross profit. Operating expenses, straight out to the question, you subtract that from gross profit to get to income from operations. The other revenues and gains are actually added to income from operations, but the other expenses and losses are a subtraction to get to income before income taxes of 275,500. On this number, you apply the 30% tax rate to get to an income tax expense of 83,250. Okay, so it's on income before income taxes that you apply the tax rate, and then you subtract the tax from the income before income taxes to get to net income of 194,250. And if you look at the solution, they'll just show you, how, for instance, how to calculate the income tax expense, etc. Questions on the income statement? All right. Earnings per share, round to 2 decimal places, so you have to be aware of that as well. If you're sitting in the test now and there's something that's asking you to calculate earnings per share and you don't know what the formula is, remember I said before also in last time's lecture that you have two things in these chapters that we learned about: return on equity and earnings per share. So also just have those formulas ready. The formula for earnings per share is net income minus the preferred dividends divided by the weighted average common stock, right, that's outstanding, because the earnings per share is specifically related to what the common stockholders have earned for the year. So you're starting with this net income number, 194. Just do this 194,250. You're subtracting the preferred stock dividend that we just saw at the beginning of the question over here, 43,050, so that you actually end up with the amount that is attributable to common stockholders, and you divide that by the common shares of common stock outstanding, which is 54,000 coming from the question again. Sometimes they call it weighted average shares outstanding. It's basically the same thing. So you divide by 54,000, and that gets you to $2.80 earnings per share. Any questions on the B part of, or the earnings per share part? All right, so that's the end of the homework. So by now I've gone through the chapter 13 homework and the chapter 14 homework with you. You know already, let me just get out of this. You know already what is in the, I'm going crazy here. What is in the test and the quiz, because this is the prep sheet. I've gone over that with you as well. You know which questions are similar to the questions that will be in the test. The other thing I wanted to show you quickly was just if you want to practice more. I mean, in this day and age, I don't know who actually has necessarily time to practice more, but I should just show you when you're going to read, study, and practice in Wiley, you can see here where it says end of chapter homework material. So these are the questions, you know, that you can practice on, and the solution for all of those questions is over here. All right, so you can maybe go through and see if there's a particular part of the chapter that you have issues with, find a question that relates to that, and then try to do that question and take it from there. What I will say though is that I do concentrate on the questions, you know, the types of questions we did in class and what we did for homework when I set the exam. So, you know, make sure that you've mastered the classwork and the homework first before you kind of go off on any kind of tangent to do other questions. Any more issues or concerns, questions about the test and the quiz? All right. So let's take a break here until noon, and then we'll spend the last, whatever, 45 minutes. Oh, sorry, I didn't give enough time for someone to ask a question. Professor. Yes. Christania, do you have a question for me? Okay. Okay, so let's take a break, everybody. And Christania, if you just want to stay on the line, can you just ask me specifically what you mean by explain a bit more about par value? All right. Christania, are you able to talk, or can you only type on the chat? Again, everybody else can go on break. I'll talk to Christania separately. Yeah. We're on break until noon. Again. I'm going to go back into chapter 15 to talk some more about issuing bonds. And I'll just do a quick run through of what we were doing on Monday, and then pick up, you know, with the bonds at a discount and so on. So just let me share my screen with you. All right. So, you know, on Monday we spoke about how companies in chapter 13 and 14, they were raising funds by giving away a piece of the company in the form of stock. So they get cash or some asset or even a service, and they give shares in return. That's one way of raising funds. Another way, as we said, is through borrowing, right? So this chapter 15 is all about borrowing, specifically long-term borrowing, long-term notes payable and bonds. We spoke about bonds, and I showed you that a bond, basically in the book you saw, it's represented as kind of like almost like a piece of paper, right? That's saying I owe you, and I owe you so much money and this much interest on, excuse me, a particular date, which is the maturity date. And then depending on how long the the bond is outstanding for, we will pay, interest periodically. In this case, it was semi-annually, and we will pay the principal or the face value, the par value, they all mean the same thing, back at the end of the term of the bond. And in this case, the face value was 100,000. So we went through all of that for bonds that were issued at face value. And then we started talking about how it's possible that a bond could be issued for less than face value. So we had said that depending on what situation the company is in, if they are trying to raise money but they're not able to pay an interest rate as high as what the people in the market are demanding, they may have to discount their bonds, meaning they basically put the bond on sale and say, yes, the face value of the bond is 100,000, but we will take less than 100,000 today, just so that you will basically give us your money, because we understand that the interest rate that we are paying on this bond is less than what the market is demanding. So the bond goes at a discount. And at that time, I was telling you about Macy's that has been downgraded to junk status, meaning that their credit is pretty bad. But so if they wanted to, I don't even know if they could, frankly, at this point, try to raise money by issuing bonds. But if they wanted to try, they would probably have to issue those bonds at less than face value, because people are just like, if we're going to borrow from you, we need an extremely high interest rate because you are high risk. And since they are already in a difficult position, they may not be able to pay such a big amount of interest. So we said that the same example here with this Candlestick Corporation, which as I already said to you is an example straight out of the textbook. The numbers may be slightly different, but the concept is the same. So they also issue, which means that they sold $100,000. That's the face value. That's what will be paid back at the end of the term, which is 5 years. 10% is the annual contractual rate, or sometimes called the coupon rate, annual rates, right? Bonds for 92,639. So they're only going to get $92,639 on January the 1st, even though in 5 years' time they have to pay back 100,000. Remember, you're always looking from the perspective of the company, not from the perspective of the person who's investing, right? Not the person who's loaning the money to the company. You are the accountant of the company. So the company is only getting 92,639. The question, as I said on Monday, could also have just said that the bonds were sold at 92.639 or 92.639%. You would have to know that you apply that percentage to the face value to get to the dollar amount that the company is raising. The bonds pay interest semi-annually every 6 months on January the 1st and July the 1st. So on Monday, I said to you, even though the company is getting less money at the start, right, of this arrangement, the 10% is a contractual interest rate. So it means that they still have to pay cash of 10% on $100,000 to the investors. And this is part of what makes the investment a little bit more attractive to people lending money to the company, is that they give less cash, right, at the beginning. They get 100,000 at the end, and the interest that is paid is still the 10% on the 100. thousand. So how do we do this journal entry? Remember, the company is receiving money and they're going to have a liability. They debit cash with 92,639. You have to credit the bond payable with the face value always. All right, so that's a must. You don't credit it with 92,639. And then the difference goes to this new account that we see now called discount on bonds payable. So it's basically an account that is going to take the difference between the cash that was received and the face value of the bond. And the discount on bonds payable, so yeah, we've got some more words to deal with. The discount on the bonds payable is a contra liability account. So that means it's a liability, but it has a debit balance and it's deducted from bonds payable on the balance sheet to get to the carrying value of the bond. I know I showed you this last time, but I'll just show it to you again, how the discount is represented. This is all from the textbook, how it's represented in the balance sheet. There you go, right? So it's long-term liabilities is the section of the balance sheet that we're dealing with. Bonds payable, this is the face value that you show because that's what went into the account. And then you subtract, right, the discount on bonds payable of 2,000 to get to a 98,000 carrying value of the bond. Sorry, wrong thing. And as I said, the interest is still calculated the same way. So that's bonds at a discount. Let's go into, let me see if it's, I'm just going to talk you through the premium and then we'll do an example together that shows all three, that shows the bonds at face, at a discount, and at a premium. And then we can cover, any major questions after that. So issuing the bonds at a premium, this is kind of the opposite, right, of the discount. This is when a company is so popular with investors, the company says we're going to issue bonds and everybody scrambles, right, to get to these bonds. They definitely want to participate. And as a result, the company actually increases basically the issue price of the bonds because there's just so much demand. And that often is because the interest rate that the company is offering is more than what the market is offering. So investors are looking for returns. They want some type of, return on their investment. And if you're willing to give them a higher return than someone else, then there's going to be more of a demand for your financial instrument. So the market is returning less than what the company is returning. So the investors will pay more than the full price of the bond in order to get that semi-annual or annual interest rate that is so much higher than what the market is demanding. The company will then issue the bond at a premium, so it's above face value. And this is just saying the same thing. If the interest rate on the bond is more than the market interest rate, the bond is issued at a premium. Stop me if this is not making sense. I feel like we kind of spoke about some of the stuff already on Monday. Maybe people remember, maybe people are asleep or doing other things. I can't tell, but I'm hoping that you're following. On January the 1st, 2013, Candlestick Corporation issues, there's the same info, right? $100,000 is the face value of a 5-year, that's the term, so it would be paid back after 5 years, 10% annual contractual interest rate for 108,111. So it could also have been expressed as 108.111 or 108.11%. You would have to just multiply out. So they are receiving more than face value. The bonds pay interest semi-annually. We already determined that we wouldn't have to do anything with interest on day one. This is just the journal entry for the issuance of the bonds at a premium. So I lost my debits. Oops. And credits here. So for cash is a fact, right? Whatever you're actually receiving is what goes into the cash account. So you debit cash with a 108,111 because that's what they actually received. Bonds payable, notice again, it goes in at face value, because that is the amount that you will be paying off at the end. So you don't have to, you can basically always remember that as a rule. The bonds payable go into the account at face value and they'll come out of that account at face value. So any changes that happen, right, if a bond is not issued at face, if it's issued at a discount or a premium, it's going to affect the cash account and either the discount on bonds payable or the premium on bonds payable. So yeah, because the because the debit side, the cash, is higher than the face value of the bond, you're going to have a credit account to pick up the difference. And that credit account is called premium, right? Premium always means something that's higher, right? If you say it's a premium product, it means it's above the rest. So premium is just meaning that we actually sold these bonds for higher than the face value. And this balance would then be added onto the face value of the bond in the balance sheet in order to get to the carrying value. So let's see if we can find that information here somewhere. Hopefully they show it, right? So they use the same $2,000. But yeah, this is showing the balance sheets, right? So it's the long-term liabilities section of the balance sheet, which would be in the stockholders' equity and liabilities section of the balance sheet. Bonds payable always and forever at face value, but you add, right, the premium on bonds payable of 2,000 so that the carrying value, 102,000, is in fact higher than the face value. So people are ending up getting less, I guess, effectively a lower interest rate than 10%, because they're overpaying at the beginning and only getting 10% interest. So the extra 8,111 that they're overpaying is cutting into their return, on the investment. Questions on the premium approach? Nothing? All right. So why don't we, sorry, I was just looking for something which I think I'm able to find. Why don't we go ahead and look at the questions again? If you still don't know where to find this information, remember Zoom call materials is where it's at. All the stuff is here for our call. Oh, and I forgot to say that the Monday YouTube lesson did go up, and I just put it as a link over here. This lesson was the beginning of chapter 15. Remember, it was just a 1 hour because I had to have a meeting at noon. All right, so that's where the information is. Let's look at this exercise number 2 to see if we are able to figure this whole thing out. I'm just trying to see what else I have. Okay, exercise 2. So reading from the top, phantom company issues. So there you have it, right? $100,000, that is going to be your face value, right? A 4-year, that's your term on the bond, so it's going to be paid back after 4 years. 10% bonds, that's an annual interest rate, so that means you're getting 10% every year, not 10% over 4 years, right? Not 2.5% per year, but actually 10% interest per year. Bonds on January the 1st, 2013, that's the issue date. So if you are doing journal entries on the date of issuance, that's the date that you will use. Interest is paid semi-annually on July the 1st and January the 1st, all right? So we've seen this type of information before. Prepare the journal entries to record, there's the wording, the issuance of the bonds, if they were issued at, so now we're getting given 3 different scenarios, right? You've got issued at 100, which is face value, so the same amount. Is this 95 a discount or a premium?
Discount?
Mm-hmm. It's less than 100, so it's a discount. It means 95% of face value, right? And 102, which is obviously a premium, 102%, right, of face value being 100,000. So what I'm going to do now, just to check the wakefulness of the people on this line, is ask you to try to do at least start with number one, but try to do these three scenarios on your own. There are three separate journal entries. All right. I'm going to give you about, let's say, 6 or 7 minutes to try it on your own. Don't shout out anything. If you're stuck for 6 or 7 minutes and you have no idea what's going on, go back to the handout and you can see how the journal entries are being done. All right. So take this time now until about 12:22 or 12:23 to try to do these questions, and then I'll do it afterwards with you. And again, please. All right. So as we said, we have the wanting to do the journal entries to record the issuance of the bonds. So I'm just going to set myself up. Debits and credits. This is very small. Just 1 second. All right. So for number one, we will have to look at the amount, right? The dollar amount that is given. So $100,000, since it's face value, it's going to be fairly obvious. You debit cash, right, with $100,000, and you credit bonds payable with the same. Questions there? Anybody want to take a stab at number two? 95. All right. You want me to do it, right? All right. So debit cash. And yeah, you're going to say $100,000 times 95%, right? Because it's saying you're issuing it at 95% of face value, so 95,000. Your bonds payable is still going to go in at face value. So you have an issue in that you're missing $5,000 on the debit side, and the name of that account is what?
Discount.
Discount on bonds payable. So that's the answer for number two, which is the 90. Oh, sorry, what am I doing? Number two, which is the 95. So this discount on bonds payable will be the contra liability that we discussed before, which gets subtracted from the bonds payable face amount on the balance sheet, right? To show, let me just go back here, to show, now I've gone too far, pardon me. There, to show the carrying value. That's how it eventually gets represented. And then item number three is going to be the premium scenario, 102, right, or 102%. So cash is going to be 100,000 times one, either 102%, like just check if you know how to use your calculator, or you can just multiply it by 1.02, so 100,000. Sometimes the phone calculators, if you put 102%, the number gets completely crazy, right? So what's 2% of 100,000 is 2,000, so you should be able to figure out that your answer has to be 102,000. And then over here, you've got bonds payable again going in. I'm just doing the stuff that we know, right? We know that bonds payable has to go in at 100,000. The difference between these two is 2,000 that you still need on the credit side, and the name, sorry, of that account is premium on bonds payable, which is an account that will get added to the bonds payable face value amount in the balance sheet. And I believe the next part of this question asks for that, the balance sheet presentation anyway. And I'll do it with you now. Does anybody have questions on items 1, 2, and 3? Okay, no one's looking for me on chat. There's silence on the call, so I'll move on. So in part B, they say show how the long-term liabilities section of the balance sheet looks following the bond issues in A. So they're saying for A 1, 2, and 3, what does the balance sheet look like? So I'll work through that with you. So for B, for number 1, let's just take them one at a time, right? So I'll do the headings and stuff for the first one, and then afterwards we can just show how the thing changes. So it's the name of the company, right? Phantom Company. The name of the financial statement, it's going to be a partial balance sheet. The date is going to be January the 1st, 2013, based on the question, right? And if you want to know the main heading where this goes into, although the book doesn't go into all of this, the balance sheet is assets, and then it's liabilities and stockholders' equity. So the main section is liabilities and stockholders' equity, and then we're going to say long-term liabilities like we have in the textbook. And in Wiley, most of this is going to be given to you anyway, because they normally already include the bulk of the information. So long-term liabilities, you're going to say bonds payable, right? Remember, this is for number 1, and it's as simple as just saying 100,000, and you're done. All right, that's how the balance sheet will look for the first scenario where the bond is just issued at face. When the bond is issued at a discount, you have a little bit more work to do. Sorry. So yeah, you're going to, I'm assuming everything else stays the same. You're going to say bonds payable. It's still 100,000, but then what are you going to do with the discount? Add or subtract?
Subtract 5,000.
Less discount on bonds payable, 5,000, and then your carrying amount becomes 95,000. This is again referred to as the carrying value or carrying amount of the bond. It's going to be referred to a few times when we're doing other work, so I want you to be aware of this information. Questions there? All right. Last one is the premium. You're just going to add the premium to the balance. Remember, again, this is a balance sheet. So bonds payable, still at face, add premium on bonds payable, 2,000. So now the carrying value becomes 102,000, which on day 1 is the same as the amount of cash that you are receiving. That's the answer to B, right? Show how the long-term liabilities section of the balance sheet. Sorry, I don't know why I wrote how. It's supposed to be show the long-term liability section of the balance sheet following the bond issues in A. And from my understanding, I'm just going to go away from this for a second. From my understanding, I know everybody's focused on the test for now, which is fine, but I believe at least one question in chapter 15, and I'm kind of taking a chance here because I can't remember which which one is set up like this. Yeah, this one, exercise 1505. You see how they ask the same type of thing, right? Do this issuance if the bond was at face, if it was a discount, if it was at a premium, and the redemption stuff we haven't come to yet. But I'm just showing you that this is going to come up in your homework. And then the last piece just says show the journal entry for the payment of bond interest on July the 1st, 2013, assuming that the bonds were issued at 100 or at face value. So you guys go ahead and do your calculation for interest and then the journal entry for interest payment. Again, don't shout out anything. Just let's take about 3 or 4 minutes for everybody to calculate bond interest on July the 1st. Write down what you think the journal entry should be, and then I'll do the answer with you at about 12:37. All right. What are we thinking? Let me get back here. So we want to calculate interest, right? what's the process going to be for calculation of this interest? Face value times interest rate times time that has passed. So it's all of January, all of February, all of March, all of April, all of May, and all of June. You don't count in July because it's July the 1st. So it's 6 months over 12 months. How much does that come to? Hopefully this isn't, too difficult.
5,000.
Yep, thank you, 5,000. What's the, whoever's speaking, can you tell me the journal entry?
Interest expense.
Yeah. And what's the credit?
Cash.
Yes, who's talking?
Kalen.
Thank you, Helen. Debit, interest, expense, credit, cash. You're done. That is it. That's the end of exercise 2. So again, in this exercise, you were able to cover the journal entries for bonds payable at face value or par, at a discount, at a premium. You saw what the balance sheet looks like when they're issued in those 3 scenarios, and also a reminder of how to calculate interest payment amounts. All right, and so at this point, I will just give you a tiny preview of what's coming next time. We will talk about what the journal entry is when we retire, which is a fancy way of saying repay the bond amount. You could probably guess that if the bond is repaid when it's due, remember when you issue the bond, you issue it, you get, if I just go right back up here, when we issue the bond, right, at par value or at face, you receive cash and you have a liability. When you settle or repay the bond, the liability goes down and your cash also goes down. That's the redemption of a bond at maturity. If you redeem before maturity, it's a much more involved process that definitely will, in my opinion, need people to be on the call so that I can explain it to you properly, and you can ask me questions, because the redemption of the bond before maturity is definitely a place where people get stuck. And after that, we'll just talk about how we account for converting bonds into common stock, and then we move into how to account for a mortgage, like if you buy a property, and then the last piece is the leases, which is very, very basic. So I think looking ahead, probably the most involved part of what's left over is the bond redemption before maturity. This is where I'll end it. I just wanted to say that, I did put out some announcements about this, and if people want to contact me separately, they can. I mean, you don't have to talk about this now on the call, but the LaGuardia does have money through the foundation emergency funds that students can apply for. I don't know if any of you already did use this information that I sent on April the 22nd. Please do take advantage of the fact that there are funds available. It might take, I think they said, up to 10 days, unfortunately, for 2 weeks, right, for this this money or for the application to be processed. But if you need additional funding, please apply. If you are thinking about into the fall and so on, and you qualify for the LaGuardia Foundation scholarship, please consider applying for that. If there are more immediate needs, remember I said that the LaGuardia food pantry is still open, and food can be gotten there from 9 to 5. There's also obviously 3 free meals for any New Yorkers at any school in your area. And then there's also one more thing that's going to happen as a result of the CARES Act, which is, you know, the stimulus that the government is doing. CUNY-wide, I think there's about, I don't know that the funds have come loose yet, like that they've been received, but there's going to be something in the arena of $100,000. Not 100, sorry, I'm going crazy. $100 million that has to be distributed to students for, you know, for assistance. And I think that, you know, I wasn't able to get a clear answer from the administration, but I think that the way in which that's going to happen is based on whether people were Pell Grant recipients, so basically based on income levels. And I'm still trying to work, well, not to work, but to basically bug the powers that be to figure out how that money is going to be made available to students. So if you are in need, or you know, also if you need support from a mental health perspective, we do have a wellness center. I haven't had, you know, personal experience with them to the extent of knowing exactly how busy they are and so on right now. But if you need other types of assistance, remember there's also NYC Well, WELL, that that provides free mental health counseling, you know, in this time of COVID-19. And as I said, if you are experiencing something that is an impediment to you completing your work, whether it be your own illness or illness of people in your home, or just general, you know, chaos that's going on, trust me, I'm also in that boat a little bit. Please, please, please reach out to me. Let's try and see what we can do. It's my goal to try and make sure that people are going to complete this class successfully. So I can't help you if I don't know what you need. All right, so feel free to email me at any time. That's it. I have the attendance. Good luck on the test and the quiz. If there's anything that happens with the test and the quiz, you get kicked out or something goes wrong, again, feel free to contact me so that I can try to get you back into the system. All right. You are dismissed, except I think at least one person, Debbie, said she wanted to talk to me about something. If there's anybody else who wants to stick around, I'm happy to stick around until 1 o'clock if people have things they still want to tell me. Otherwise, I'll see you on Monday next week. And remember, the test is due on Sunday at 11:59 p.m. Bye-bye.
Thank you,
Thank you,
Professor. Take
Professor.
care.
Have a nice day.
You too. Bye-bye.
Thank you,
Bye.
Professor.
Also, Professor, I already solved the
Oh,
issue.
great. So I don't need to answer your email.
Unless you
I'll
want to see
ignore it.
how can I perfect me reading it? Because every time I read it, I kind of somehow read it wrong somehow.
Yeah. Yeah, I mean, are you reading slowly? Because it might be that you're impatient with yourself, so you need to read a little bit slower.
Yeah, there's a chance, or probably when I see all those numbers and I just get mixed up in
The
my head.
numbers look like, you know, things scrolling on a page almost. So that's why I was saying sometimes you just have to even have a piece of paper next to you and write out, like even when it comes to bonds, if we were doing this in class, and you know, it's a little bit different, you know, electronically, but in class I would normally write in a row. I would write what's the face value, what's the time to maturity, interest rate, you know, what's the other, semi-annual or annual. I would write all what I call the features, right, of the bond in a line, like one below the other on the sheet before I even start with the question, so that I can see what information I have and then apply that, because then you've extracted from the question the bits of information that you actually need, so you don't have to keep going back and getting confused with the numbers every time you go back to look at them again. Does that make sense?
Yeah, it does. I also gotta try to remember the format too.
Yeah, and that takes practice, man. I said it before, and I'll say it again with accounting. A lot of this isn't, you don't have to be a rocket scientist, but you have to be absolutely disciplined and committed to practicing these things many times over, because once you get the practice, you get the hang of it, then you see that the questions repeat all the time. It's the same thing over and over. All right? So just keep plugging away at it and pay attention to detail.
Thank you,
All right.
Professor. Take care. Have a
Cheers.
great week.
You too. Bye-bye.